The live trading session is currently active for Nokia Corporation on the New York Stock Exchange under the ticker symbol NOK. And as of this exact moment on Wednesday, May 20, 2026 at 12:11 p.m. Eastern Standard Time, the stock is trading at $13.67 per share, reflecting a minor intraday. Street is currently re-rating the business not as a debt-laden carrier equipment supplier, but as a core provider of data center backend systems and optical networking architecture. The broader market expectation was that the company would slowly fade into the background as 5G buildouts matured and capital expenditure from major carriers cooled down, but the reality is that their optical network sales surged 49% year-over-year in the most recent quarter, booking over €1 billion in hardware orders specifically tied to infrastructure clusters. Investors who rely on outdated narratives are completely missing how deep this enterprise transformation goes, especially when you look at the major institutional positioning happening across major online investment platforms and online investing channels. The disconnect between public perception and actual corporate velocity has created a unique dynamic in the current market layout. For years, ordinary investors looking for investment help or managing their own self-investing strategies through an individual brokerage would look at legacy technology firms and dismiss them as flat, dividend-paying income traps. However, big financial institutions have quietly been accumulating positions. In the past month alone, major sector upgrades have triggered massive single-day trading spikes, including a nearly 10% single-day move following an aggressive upgrade from Bank of America, which lifted its outlook based on the company's emergence as a vital Western sovereign-level supplier. This structural advantage became incredibly apparent after European and domestic regulators restricted Chinese equipment providers, essentially leaving this Finnish infrastructure giant as one of the few trusted entities capable of handling sensitive enterprise and federal connectivity. When you look at retail trading volumes across mainstream platforms like the Robinhood app, Robinhood Investments, and Robinhood Stock Trading, the name has historically been treated as a cheap retail trading vehicle, but the structural shifting of capital toward advanced optical routing tells a completely different story. Recent market data highlights an intense wave of sector-wide momentum that is lifting the entire networking space. Just last week, Cisco Systems delivered an incredibly robust quarterly report that blew past traditional enterprise spending expectations, showing a massive 25% spike in raw networking revenue driven by a wave of capital layout for cloud data centers and campus equipment. That single report sent shockwaves through the market, causing Cisco to jump over 20% and dragging Nokia up by more than 10% in sympathy as traders realize the sheer scale of the hardware deployment currently taking place globally. Hyperscalers are planning to spend hundreds of billions throughout the remainder of this year to support advanced processing clusters and massive machine learning models. This massive spending directly feeds into the optical and IP network systems that this firm builds, leading management to officially raise their net sales growth guidance for the network infrastructure division to a range of 12 to 14% for the full year. This isn't just standard market cyclicality, it is a fundamental reset of the company's total addressable market. If you look at the trading data, institutional interest is expanding rapidly outside of standard telecom funds. Portfolio managers utilizing sophisticated tools like Schwab Intelligent Portfolios and other high-end intelligent portfolio systems are seeing their automated algorithms pick up on the company's dramatic margin expansion and debt management. The acquisition of Infinera has given the firm an incredibly strong foothold in North American data center interconnect markets, allowing them to capture business that previously went entirely to specialized domestic fiber providers. To secure this market further, the firm recently locked in a highly publicized $4 billion investment commitment, focused on expanding domestic production and research facilities within the United States. This aggressive layout adds to the heavy capital already integrated via the Infinera transaction, aligning the company perfectly with a political and regulatory landscape that heavily rewards domestic and allied nation manufacturing. As retail traders browse popular investing sites to pick out high-flying semiconductor names, the foundational optical layer that connects these chips is being locked down by a business trading at a fraction of the multiples seen across the rest of the technology sector. To understand the full scope of this momentum, we have to look closely at the strategic partnerships that are fundamentally redefining the company's forward path. The company has secured an extensive technical collaboration with NVIDIA to develop advanced radio access networks that run concurrent workloads on shared graphics processing infrastructure. This collaboration has successfully completed initial live field testing with global operators like T-Mobile and SoftBank, proving that standard telecom towers can pull double duty by processing local compute workloads alongside standard mobile traffic. This massive technological leap has brought a vast ecosystem of hardware partners into the mix, including server manufacturers like Supermicro and enterprise software providers like Red Hat. While ordinary retail investors are busy tracking extreme daily swings in NVIDIA stock or Apple stock on their phone screen, the infrastructure layer required to make these mobile software tools work efficiently is quietly being built out in the background. Let us pause for a second and gauge where the community stands on this massive enterprise transition. Comment below how many shares of Nokia you currently hold in your portfolio, and let me know if you believe Wall Street will successfully re-rate this company as a high-margin technology infrastructure play before the year ends, or if you think the old telecom stigma will continue to hold the stock price back.
When we strip away the recent trading volume and step back to look at what the company actually does, the core business model relies on licensing intellectual property and building heavy-duty hardware that forms the backbone of global communication. The business is split into two primary operational units, network infrastructure and mobile infrastructure. By intentionally selling off lower-margin legacy assets like their microwave divisions and regional enterprise campus groups, the company has successfully pushed its comparable gross margin up to a healthy 45.5%. Their business model is no longer about chasing low-margin market share at any cost against commoditized Asian manufacturers. It is about providing high-performance, secure, and sovereign-approved routing hardware to cloud providers and Western governments. Historically, the company survived on massive multi-year carrier build-out contracts that left them vulnerable to sudden pauses in telecom spending. Today, their revenue mix is shifting rapidly toward recurring software enterprise agreements and high-margin optical hardware sales, generating over $578 million in operational cash flow in the opening months of the year alone. This current financial health is a massive departure from the older reports and past performance metrics that older market participants still associate with the name. 5 years ago, the business was plagued by execution missteps during the early rollouts of 5G, which forced them to cut their dividend, undergo painful restructurings, and clear out legacy executive leadership. Those historical struggles left a long-lasting scar on the stock chart, keeping the valuation compressed for nearly a decade and making it a forgotten name among active growth investors. However, those years of severe cost-cutting and portfolio simplification are precisely what allowed the company to accumulate its current €3.8 billion net cash position. The company has rebuilt its balance sheet to a level of stability where they can comfortably support continuous share buybacks and pay out reliable quarterly dividends, while simultaneously funding massive research and development programs. Looking ahead, the central tension between expectation and reality will be decided by how effectively the company executes its multi-year operational targets leading up to 2028. The current market expectation, which is reflected in a trailing earnings multiple that sits slightly above 30 times, assumes that the recent surge in data center sales is a short-term infrastructure pull forward that will eventually normalize back down to historical single-digit growth rates. The reality, however, could look vastly different if their newly released software automation tools for broadband and home networks take off as expected. The global telecom sector is projected to allocate over $6 billion towards software automation by 2030, and the firm is aggressively positioning its proprietary models to capture the lion's share of that market. If they can successfully hit their long-term targets of converting up to 75% of their operating profit directly into free cash flow, the current stock price will look remarkably cheap in hindsight compared to the highly inflated multiples found across rival networking entities. The primary risks to this bullish thesis lie in execution and macroeconomic cyclicality. If corporate capital expenditure slows down due to broader monetary tightening or regional economic pressures, hyperscalers might choose to extend the lifespan of their existing optical architecture rather than upgrading to the company's latest high-capacity systems. Furthermore, integrating massive international acquisitions always carries organizational friction that can temporarily hurt operating margins. Investors managing assets across legacy firms like Fidelity Investments, checking their positions via the Fidelity mobile app, or browsing specialized Fidelity mutual funds and Fidelity brokerage accounts will need to closely monitor the upcoming quarterly financial report, scheduled for July 23rd. Wall Street consensus is currently looking for an earnings print of 7 cents per share, which represents a substantial 40% jump year over year. Any miss on that core number would give bears the ammunition they need to argue that the infrastructure transformation is taking longer to materialize than the bulls expect. When you look at the broader landscape of modern online investing, from individual brokerage setups to active trading platforms like SoFi Invest or Interactive Brokers, the true value is almost always found in the spaces where public narrative diverges wildly from institutional execution. The central insight here is that the market has spent years treating this asset as a forgotten remnant of a bygone technology cycle, whereas the hard financial data reveals a lean, cash-rich, sovereign-backed network specialist that is actively capturing billions in data center infrastructure spending. The old expectation was a slow decline into irrelevance. The current reality is a structural re-rating driven by expanding gross margins, highly strategic North American investments, and massive validation from the leading processors in the hardware space. As the market moves forward into the next phase of enterprise infrastructure deployment, the companies that control the foundational physical routing layers are the ones holding the real structural leverage, leaving this legacy giant in a position that the broader market is only just beginning to truly understand.
That 5G build-outs matured and capital expenditure from major carriers cooled down. But the reality is that their optical network sales surged 49% year over year in the most recent quarter, booking over €1 billion in hardware orders specifically tied to infrastructure clusters. Investors who rely on outdated narratives are completely missing how deep this enterprise transformation goes, especially when you look at the major institutional positioning happening across major online investment platforms and online investing channels. The disconnect between public perception